So I live in this apartment complex in Bangalore. This week we celebrated Kannada Rajyotsava with a lot of fanfare. I had gone down to meet my friend. One of her very interesting neighbors asked me very excitedly, "Hey Anand, what's your view on the reappointment of Jeremy Powell as the Fed chairman? What will be the impact of this particular appointment on Indian equity markets?" I was zapped. To be honest, I was clueless and never had an answer for this. I told him that it may be inconsequential for my portfolio and it may not really matter to Indian equity markets at all. But he was not convinced. I did what I could do, and on my way, I was just thinking about the negative impact of being so very well connected to the globe. The habit of reading every bit of the headlines, which may not really matter to you and me, can be detrimental to our portfolio. And this is not where we end. We do a lot of other mistakes as investors. And therefore, I thought in this video, I will touch base upon most common mistakes as an investor. And knowing them, you may become a better investor. Please watch till the end. The biggest mistake that we as investors make is we all think long term but act short term. In the last 18 years of my career of managing large set of money, one thing that I've noticed is that every investor always says that this money is for my kid, this money is for my retirement. I'm not going to look at it at all. I'm not really worried at all. But the moment they invest the money, they start tracking the markets. They start tracking the portfolio. And if there is a percent fall, they pick up the phone and worriedly ask you, why did it actually happen? Everybody knows compounding works beautifully over long term. I have myself made videos and there are tons of other videos on power of compounding. But nobody, literally nobody allows power of compounding to show its magic. This is where I feel I have an edge. You are not going to act long term. I'm going to act long term, and power of compounding is bound to work for me. Plus, they all see the money that you've made. What I mean here is that, let's say you have invested 50,000 rupees and you made 10,000 rupees and I made 10 lakh rupees. Net, both of us have made 20%. Because the amount of 10,000 looks small, you're not happy. You're always looking at the money, but not looking at the percentage gains. We both made the same returns. We should not be concerned about absolute money, but always look at percentage returns. Third thing that they always do in this, they start watching their portfolio very actively, and then at some point in time, they get anchored to a certain value. God forbid, if that value dips from the level that you got anchored to, it creates heartburn, impatience. Not so great feeling about portfolio, but net, you're in a much better position than a year or 2 years or 3 years back. But nobody is bothered about that. If you're thinking long term, please act long term. If you're thinking short term, please act short term. The one thing that I've noted after reading a lot of books about investors who are legendary or meeting legendary investors in my own capacity is that they never let their losses pile up, stack up. Losses doesn't really mean that it is all about money. There are times when you're wrong about a certain thesis, about a certain stock, or a fund, or an asset class. And if you figure out that it is not correct, they immediately, I underline the word immediately, cut down on their losses. This is a great sign because capital saved by cutting down the losses is also, at the end of the day, capital earned, isn't it? While the same set of investors, on the other hand, let their profits run. They never cut down their profits. They continue to invest into the same set of company. Let's say you invest 100 rupees into a certain fund and that 100 becomes 200. Doesn't mean that the 200 cannot become 400, the 400 cannot become 1000. As long as the execution of that particular fund is top notch, you can always double your money, triple your money, quadruple your money. And therefore, what's the point of doing so much analysis and then at the end of the day you say that, okay, I've doubled my money, let me exit out of it. Let the profits run. Continue cutting down your losses and let the profits grow. This can apply, by the way, to your short-term trading too. Everyone knows the benefits of diversification. I agree, diversification makes a lot of sense. But do you know that diversification or adding a new fund or a stock beyond a certain level, which is about 18 stocks or 5 mutual funds, it does add up to the number, but it doesn't help your portfolio. Let's say you're great at analysis. You do brilliant work on spotting the next big multi-bagger. If I go and see your portfolio, you've just allocated 2% or 3% of your capital in it. Then why do these big reading? Why do these extensive analysis? If you're just going to allocate 2%, you're just doing the job of index fund. If you're convinced, you should actually allocate 5%, 10%, 15%. Because at the end of the day, conviction drives returns, not diversification after a certain point in time, of course. And therefore, if you're convinced that a certain asset or a fund or a stock is good for you, try not to diversify way too much. Don't put all eggs in the basket, but don't add too many eggs into the same basket too. I'm going to unleash the biggest myth of the market, that you can time the market by seeing some charts. I'm not degrading technical analysis. All I'm saying is that nobody knows when to buy and when to sell and be right about it all the time. You can be always lucky. You know, right? Even a stop clock is correct twice a day. But making this as a part of your strategy, I don't think is a great idea. Remember, the company runs on fundamentals. And fundamentally, if you see that the company and the management and the fund manager and the asset class manager are doing well, then continue to stay invested with them. Spend time with them. Don't try to time them. This way, you will reduce the cost and generate a lot more wealth. Trust me, lot more wealth than by entering a same script. Everyone wants to grow rich, isn't it? Everyone wants to have a lot of money so that they can do what they really want to do with their time and money. But they all think that they need to start big, to grow big and have a large set of money at the end of the day, which is a clear myth. It's not true at all, even one bit. I'll tell you a true story. I have a very close relative. She came to me when she was maybe 26 years old. She said, I want to start saving, but unfortunately, I can save only about 5,000 rupees per month. Remember, she's a close relative. I said, why don't you start with that 5,000 rupees? So today, it's been 6 years since I started managing her wealth. You won't believe that portfolio has grown on to become close to 90 lakh rupees today. I'm not saying that 5,000 has grown. She has started investing smartly, saving even more smartly. But the point I'm trying to make is that she started. So it doesn't matter you start big or you start small. All that should matter to you is just start saving today. All the best.